We are entering the lost decade of investing, creating a fear of loss situation for the investors. Therefore, we need to start preparing ourselves for the next 10 years. Hi and welcome to Investing Trends, where we give you the latest news in today's market. Today, we will be talking about how you can prepare yourself for this time in the stock market. If you're looking forward to investing, it is important that you prepare yourself. So stay tuned, because we are going to discuss everything you need to know before investing in this decade. Let's begin. Despite the fact that stock prices have fallen on many occasions during the last year, 2021 has been a good year for investors, but we are not certain if the next stock market crisis is imminent. Stock prices are now high, which could lead to a short-term slump. However, this does not imply that the market will fully collapse. Furthermore, stock prices have been high for a long time, and while the market did take a knock in March 2020 when the pandemic initially struck, it swiftly recovered. As a result, if markets do drop this year, the decline may be brief. Big stock market losses aren't anyone's definition of a good time, but they've been happening with alarming regularity this year. It's not just a terrible day or a bad week, it's a poor year. The S&P 500 has dropped for 7 weeks in a row, momentarily entering the bear market territory. You may not want to look at your portfolio right now if you're a long-term investor. The figures may be alarming. Here's 3 tips to how you can prepare for this decade. Number 1. Diversify your portfolio. When preparing for a future economic downturn, diversification is essential. You may avoid company-specific risk by investing in funds rather than individual companies, because you're less likely to notice a company going bankrupt, among several others. A diversified investment portfolio may be just what you need to weather a stock market downturn. As a result, it is essential to do a thorough evaluation of your investments to ensure that they are as well balanced as you want them to be. Stocks and other assets can fluctuate in value, leaving you with a situation where you're more heavily involved in a single market area than you'd like. So try to double check that this hasn't happened to your portfolio, and if it has, it is wise to rebalance before stock prices fall. So, the bottom line is, when a recession hits, it's best to think long-term and manage your exposures, limiting risk and putting money aside to invest when the economy recovers. While no investor can predict the commencement of a recession with any degree of certainty, prudent diversification ahead of time can help you protect wealth and position yourself to profit from a rebound. Number 2. Allocate your bonds. The Fed's rate hikes have lowered bond values because market interest rates and bond prices normally move in opposing directions. On the 10-year Treasury yield, which rises when bond prices fall, has hit 3.1%, the highest level since 2018. Bonds, despite falling prices, are still an important part of your portfolio. If stock prices fall as a result of the impending recession, interest rates may fall as well, allowing bond prices to rise and balance stock losses. That negative correlation tends to emerge over time. It isn't always on a daily basis. You can manage your bonds before the recession in 3 ways. It's essential to remember that a recession isn't the only factor that affects bond performance. It is the interest rate changes that are important. Bond prices rise when interest rates fall, and vice versa. But in previous recessions, interest rates have shifted in both directions. And if the Federal Reserve wants to jumpstart economic growth, a recession may be more likely to bring interest rate reduction. The yield curve, which expresses bond investor risk altitude, is one potential recession signal. When the yield curve inverts, it may be a sign that a recession is approaching. Moreover, when interest rates fall, investors should be aware of how bond prices and yields shift. This is due to interest rate risk, which is a risk that bondholders face as interest rates fluctuate. Interest rate risk is determined by a number of factors. Firstly, check the duration of your bonds. Short-duration bonds, on the other hand, may be better to own during a recession because they mature more quickly regardless of value. Longer-term bonds may be more susceptible to rate movements, losing or gaining more value depending on the direction rates move. In a recession, non-callable bonds may be preferred over the third alternative. Bonds that are not callable, such as U.S. Treasury bonds, cannot be called or redeemed before their maturity date. Secondly, you should consider allocating to bond funds. Short-term bond funds are safer than long-term bond funds, which can help decrease portfolio volatility and risk, Braddock adds. They're also more liquid, making it easier for investors to get their money. It's vital to analyze the underlying assets and how they fit into a portfolio's existing diversification strategy when determining which bond funds or ETFs may outperform in a recession. Thirdly, it is essential to choose quality rather than quantity. Credit risk is another concern that investors should be aware of when a recession is on the horizon. He claims that some bonds are guaranteed and others aren't, but that the guarantees aren't all the same. For example, a bond guaranteed by the federal government overrides a bond guaranteed by a state government agency. In a recession, both of these are preferable to municipal bonds, with corporate bonds ranking fourth on the list according to analysts. Investors seeking reliable fixed income assets may find government and corporate bonds appealing during the recession. These bonds may be more suited to helping investors to maintain or grow purchasing power if inflationary changes occur as a result of a recession. Number 3. Make cash reserves. Cash has grown less appealing in the face of rising inflation and poor savings account rates. However, retirees must maintain a cash reserve to prevent the sequence of returns danger. You should be cautious while selling assets and withdrawing funds, as this could affect your portfolio in the long run. That's how you get caught in a negative run of returns, which will eat your retirement alive. With a strong financial cushion and access to a home equity line of credit, retirees can avoid touching their nest egg during periods of steep losses, he added. Having a healthy emergency fund and enough money in the bank to cover 3 to 6 months' worth of essential living expenditures is always a good idea. That way, if you lose your job or have unexpected expenses, you'll have cash reserves to fall back on instead of going into debt or liquidating equities to make ends meet. That's all for today. I hope you'll keep these preventive measures in mind before making an investment. Thank you for watching. Stay tuned for more informative videos coming your way. And don't forget to like and subscribe to our channel and hit the bell icon on your way out.